I'm Edgar Norton, a professor of finance and a CFA charter holder. The CFA designation stands for Chartered Financial Analyst. It's a professional designation for persons involved in wealth management, stock and bond analysis, and portfolio management. Welcome to this module on financial literacy. Let's talk about some financial planning basics. We'll start with the pyramid with 3 stages or levels. The concept of the financial planning pyramid is used to explain the financial planning process. As in any construction project, whether creating a home, office, or financial security, we first need to build a solid foundation. Once the foundation is in place, we can start framing the house or building financial wealth. But unlike most home or office buildings, building financial wealth or financial security can take many years. In fact, most of our working lives. Someone who retires at age 60 may have 40 years in retirement, thanks to healthier lifestyles and modern medicine. Thus, once we get out of college and start working full-time, we need to build financial wealth during our working career. Finally, as a person nears retirement, they can top off their financial house with a plan for making their savings last as long as they do, and if married, as long as their spouse lives too, and perhaps plan for a legacy by giving funds to family, friends, or charities. The financial planning process is visualized in the financial planning pyramid has 3 levels or stages. Stage 1, or the foundation, is there to help protect against life's uncertainties, such as accidents, illness, large expenses, and so on. Stage 2 builds on that foundation. Here's where we accumulate wealth. That is, we save and invest for various goals, such as a down payment on a house or retirement, or maybe college education for our children, among other possible goals. And finally, stage 3 is the capstone. That's retirement and estate planning. That is, this is for when we're no longer working, so there's a need to manage our retirement assets and spend our money prudently, and to plan, if desired, to conserve and distribute any assets and wealth at our death. Our focus in this Redbird Career Portfolio module will be on the foundation, the first level, the first stage, guarding against uncertainty, which we can also call managing life's risks. To increase the likelihood of a sound financial future, we need to protect ourselves against some of life's unfortunate events. Some happen because of nasty people, like identity theft, and some happen by chance, accidents or large unexpected bills. There are 3 basic strategies for guarding against unfortunate financial events. Number 1, we can try to guard against identity theft or ID theft. Number 2, maintain adequate insurance protection. And number 3, build up and maintain a cash emergency fund. Let's look at each of these. Number 1 is guard against identity theft. Nasty folks want to get into computer systems or just take advantage of an unsuspecting person to get access to their credit card, their debit card, or bank accounts, or other personal information. Here are suggestions from the U.S. government to help protect yourself against these crooks. Number 1, secure your Social Security number. Don't carry your Social Security card in your wallet or write your number on checks. Only give out your Social Security number when absolutely necessary. Don't respond to unsolicited requests for personal information. Your name, your birth date, Social Security number, or bank account number by phone, mail, or online. Watch out for shoulder surfers. Shield the keypad when typing your passwords on computers or your PIN at ATMs. Collect your mail promptly. Ask the post office to put your mail on hold when you're away from home or from your campus apartment for a few days. Pay attention to billing cycles. If bills or financial statements are late, contact the sender to make sure you get them on time and you can pay them on time, or they haven't been misdirected to somewhere else. Review your receipts. Promptly compare receipts with account statements. Watch for unauthorized transactions or things that are on your credit card bill that you don't recall ever charging. After you pay the bill, shred receipts, credit offers, account statements, and expired cards to prevent dumpster divers from getting your personal information. You can store personal information in a safe place at home or at work. And to help protect your computer, Install firewalls and virus protection software and virus detection software on your computer. You do want to create complex passwords. ABC123 just doesn't do it. That identity thieves cannot guess easily. Change your passwords if a company that you do business with has had a breach of its databases. Order your credit report once a year and review it to be certain that it doesn't include accounts that you have not opened or anything else that doesn't look right in your eyes. Check it more frequently if you suspect someone has gained access to your account information. Correcting and fixing problems caused by ID theft can be a big headache. Paperwork, phone calls, and submitting verified information. Although there may be little financial loss at the end of it all, that doesn't count the cost of your time and stress in dealing with it. By the way, ID theft is an issue with both debit cards and credit cards. If you give a card to waitstaff at a restaurant, it's a good idea to keep an eye on the card. That innocent-looking person processing your order may be taking down information, like your name and card number. And if they can Google information about you on the web, remember the professional reputation module from year one's activities? They can get enough information about you, including your birth date, phone number, address, and so forth, to run us some charges and apply for new cards using your name and information. Debit cards, in my opinion, are something I don't use. The big reason I don't like debit cards is, under current law, you can be liable for all transactions. If your debit card is lost or stolen, the thief can drain your bank account. You're liable for up to $50 if you don't report the loss of your debit card after it is fraudulently used, and the charges may go up to $500. With credit cards, the maximum loss is only $50. So that's why I prefer, if I'm going to not use cash, I prefer to use credit cards. Step number 2 in that stage 1 foundation is to maintain adequate insurance protection. Stuff happens. Sometimes it's our fault, like texting and driving, or someone else's. The person who hit us was distracted while driving. Sometimes it is an unfortunate illness or accident, such as slipping on ice or falling downstairs. That can lead to medical bills and lost time from work. To manage a variety of risks, the financial markets have developed financial policies. By many of us paying a relatively small premium, we receive reimbursement for some of our expenses should we be one of the relatively few that need to use insurance. This is a concept called the law of large numbers. For example, out of 10,000 people, it's fairly certain that some of them will be in a car accident, and assuming they have insurance, will need to get their cars fixed, and maybe the other person's car too, depending upon who is at fault. We don't know if you will be in an accident, just approximately what percentage of those 10,000 people who will be in an accident. Statistics give the insurance company an idea of the frequency and cost of possible losses, and they charge the insurance premium based on the risk and cost assessment. That's why car insurance rates are higher for teenagers than for 50-year-olds. There are lots of statistics and data showing teenagers get into more car accidents. And students with good grades get a car insurance discount. As stats show, they are likely to be more careful while driving, or maybe on the road less since they study so much. And that's why male teenagers pay higher premiums than female teenagers. Stats show more accidents. And smokers pay higher health and life insurance premiums, since they're more likely to get ill or not live as long as non-smokers, according to the statistics. Thus, insurance allows us to manage against some risks. By manage, I mean we pay the relatively small insurance premium and get protection against losses that can be quite large. Insurance allows us to buy protection against some of life's uncertainties or unfortunate events. But we still usually pay something if an unfortunate event does happen. This can be a deductible or a copay, or maybe both, depending upon the policy. In other words, we have to pay some of the upfront, out-of-pocket expense first before the insurance company pays anything. That is called the deductible. And we may have to pay a certain percentage of the expenses, and the insurance company will pay the rest. That's a copay. For example, for many health insurance policies, the insurance company may not reimburse any expenses until our health care expenses for the year total, say, $1,000. That $1,000 is our deductible. Once expenses exceed $1,000, we may have to pay 20% of any additional expense, while the insurance company pays the other 80%. That 20% is our copay. Here's an example. Suppose we have $3,000 in covered expenses under a policy that requires a $1,000 deductible and a 20% copay. We will pay $1,400 of the expenses, and the insurance company will pay $1,600. Our $1,400 payment is comprised of two parts. The $1,000 deductible, that comes off the top, and we must pay that amount first, plus the copay, 20% of the amount over $1,000. In this case, 20% of the $2,000 that remains of the $3,000 expense after the $1,000 deductible. So 20% of $2,000 is $400. Our total payment then is the $1,000 deductible plus the $400 copay for a total of $1,400. The insurance company will pay the remainder, or $1,600, of that $3,000 expense. So what risks does insurance allow us to manage? You're probably aware of some of these. Car insurance, legally required, provides protection in case we're in an accident and it's our fault. And we can provide protection if the other driver is breaking the law by not having car insurance, or if they're carrying too low an amount of insurance to cover the damages. Health insurance pays for some, but not all, of health-related expenses, including doctor visits, prescription drugs, hospital stays, and surgeries. There are a variety of different types of health insurance, including HMOs, or health maintenance organizations, which limit the doctors you can visit, but which may have lower out-of-pocket costs, to indemnity plans. Indemnity plans give you more choice, but you'll likely face higher deductibles and higher copays than an HMO. Renters or homeowners insurance, you live somewhere. What happens if your dwelling place is damaged by fire, a hailstorm, or theft? Who will pay for you to live elsewhere while repairs are being made? Or who will pay for the repairs? What if a thief breaks in and damages your house or steals your valuables? Renter's insurance protects against theft or damage of your belongings, TV, computer, and other valuables when you're renting a house or an apartment. The property owner should have insurance on the dwelling, but the property owner's insurance policy won't cover your belongings if they're damaged or stolen. If you own a home, you'll want homeowner's insurance to protect you and your property from fire, flood, hail, tornado, and all the other bad things that may happen to your home or around your home. For example, if someone falls on your icy sidewalk, your homeowner's insurance will help pick up some of the medical bills from that accident. Disability insurance. Have you ever seen the Aflac duck commercials? Disability insurance pays cash to the insured, either a percentage of their regular salary or a flat dollar amount each month. The payments don't cover doctor bills. That's where health insurance comes in, but they help pay living expenses, food, mortgage, rent, electric, and other utilities, while the insured is ill, injured, and unable to work. There is a deductible to disability insurance, namely the disability insurance payments do not begin until the insured has been out of work for several months. During that time, you have to pay the bills on your own from your own savings. And so what some people sometimes recognize too late is that health insurance will pay health expenses, but they won't pay living expenses if you can't work because of an illness or injury. That's where disability insurance comes in. Disability insurance helps to pay those month-to-month living expenses. Life insurance may not be on the mind for many college-age students, but once marriage, children, or a house payment occur, it's a good idea to buy protection so debts are paid and loved ones are provided for in case of an earlier than expected death. I've heard too many sad stories and seen too many GoFundMe pages for persons who didn't think the unexpected would happen, but it did, and the loved ones are left behind with financial issues. Thirdly, to try to manage life's uncertainties, we can build up and maintain a cash emergency fund. Having a cash emergency fund is a great way to manage risk, as not all risks can be handled by insurance. And sometimes it isn't a risk, it's just a normal large expense that we need to plan for. For example, if you own a car, sooner or later you'll need to buy new tires. You have to spare $400 or more? Or will you need to use a credit card and then pay off the bill with high interest over many months? And new tires aren't the worst, of course. Some car repair bills can be well over $1,000. Co-pays on expensive medical procedures or hospital stays can be quite high too. If you own a home, someday it'll need repairs and maintenance, a new water heater, a new roof, a new air conditioner. There's a reason why a house is called a money pit. And what about the cost of a new computer, TV? Your friend wants you in their wedding, and the groomsmen, bridesmaid clothes cost how much? Expenses, good, bad, expected, unexpected, happen. Having money in the bank for a cash emergency fund will help you manage risks of large expenses, planned or surprise, by keeping you from going into debt and paying high interest charges. You can whip out the credit card, pay the bill, and when the credit card bill comes, you'll have the money in the bank to pay the bill in full, and thus save money you would have had to lose over time in interest charges. Another good reason for a cash emergency fund, it helps you sleep at night, knowing you're prepared for the big expense when it comes your way. And another reason, recall our discussion about disability insurance and how the disability income payments have a deductible time period before you start receiving income if you're ill or injured and can't work. The typical waiting period is about 3 months. So having a cash emergency fund will provide for your living expenses during that time, should you be ill or hurt and unable to work. And in today's economy, there are company layoffs, mergers, closings. The lifetime job guarantee is no more. So having a cash emergency fund will help you pay the bills and keep your head above water financially should you find yourself out of a job and looking for other opportunities sometime during your working career. So how big should that cash emergency fund be? Well, hold on to your seat. We should have a cash emergency balance of 3 to 6 months of living expenses. Living expenses, not income. We work, get an income, and from our income they take out taxes. Maybe we already take some of that money, put it in savings. What we want to do is determine our monthly living expenses. More on putting together a budget later on. And over time, we need to save up, or we should save up, 3 to 6 months of living expenses for a cash emergency fund. For many, that will total $10,000 to $20,000, maybe more. Again, 3 to 6 months of living expenses can be quite a large sum, and the amount will grow over time as your income and spending grow. So you want to build up that cash emergency fund until it equals 3 to 6 months of your living expenses, and then as your expenses rise over time because of promotions, salary increases, you can spend more money, you'll have higher living expenses, you'll want to increase that cash emergency fund accordingly. This ends our first part of our discussion on this Redbird Career Portfolio video.